I wanted to make this video talking about just investing in stocks and pretty much as an update, I think, but also I want to explain a lot of reasoning from a very like first principles kind of approach where what that really means is like there are a lot of fundamental, very non biased or judgmental kind of reasons and things that you can like look at to understand and try to predict what can happen next with the economy, with the US stock market and things like that. So as always, I really recommend everybody reads, because I think reading is really important, especially to learn from what happens in the past. So this is a book I'm currently reading about the .com bubble, because as you probably know, there's an AI bubble, right? But I'm not here to talk about that book. I'm here to just talk about some of the underlying factors that I think are informing my approach to how to see, let's say, the next couple of years and what may potentially happen. So if we think about the whole story of AI and how everything started, right, I'm going to list out a lot of key assumptions that was priced in by the market in general, right, of what AI would do. So you have to remember that, I think me being in Silicon Valley, me being at Stanford, me being surrounded by a lot of really, really intelligent people all the time, it's sometimes easy to forget that everybody else doesn't always consider that, or in times of bubble mania, a lot of people who are intelligent just don't use their intelligence because they're so caught up in it, right? It's kind of the groupthink approach. So that can be used to explain the deviation of, reality from stock prices. And that's why a lot of times people can make a lot of money, because the stock prices get very far away from reality. But let's go back to the core fundamentals, right? So AI gets released as a new technology, and primarily everybody's like, hey, this is going to change the world, which it definitely is. But what happens then is everybody thinks, oh, there's a lot of fear. It's going to take over the world, going to take our jobs, all this stuff, right? And then we start to see when business actually try to implement it, there are some challenges. Now, I want to bring up this kind of term that was brought up by one of OpenAI researchers before, is like the jagged edge of intelligence. The idea that AI is going to be really good for things where there's a lot of data on it and it can train really well off of that. And it's going to be very bad for things where there's not much data. And a lot of companies suck at keeping data. So that means that there will be some aspects in industries where AI can't really help that much. And if we couple that with the fact of the hallucination rate. So the hallucination rate is actually something that's obviously improved a lot over time, right? But the fact that it still exists is a fundamental problem, because if we think about small to large business owners across the country, right, they really want everything to be, perfect all the time. If the idea of AI replacing, let's say, receptionist people, AI replacing, a lot of people inside a company, if that's actually to come to fruition, what must happen is all aspects of how AI operates must be flawless, because if there are those, mistakes, the business owners are not going to want to have those mistakes, because that can drive away potential customers and actually lose them money, right? And that can happen quite easily, especially if you consider that, AI, when you talk to it for very long periods of time, the context can kind of be limited, right? And so we're just talking these kind of more broader situations. I'm just bringing this up as a more balanced view, right? So then if we consider that, then we have a big rush of people saying, oh, we need more chips, okay? And I would really question that, because, if you go back to when DeepSeek first came out, right, remember how that revolutionized everything. And people, now a lot of people are saying, well, maybe chips aren't the way, right? And the idea is that, well, if we just have more computing power, right, then we'll be able to solve all these problems. But that can't possibly be the truth, because essentially AI in a sense is like an algorithm, right? And so if you do research over time, algorithms get better. That's why we are to where we are today, because there's a lot of improvements over time, right? So if you're going to say that, oh, if I just have a faster computer and I keep running the same slow algorithm, then I'll eventually get to a good kind of, result. I mean, this is a very dumbed down kind of not completely, detailed approach to how you can easily think about AI in an abstract sense. But it's no, we would just want to refine the algorithm so it can run on much less power. But there's a big rush to be okay, well, no. We need to have, chip dominance. And then there's also this rise of this kind of natural language processing and this one-sided approach as this is the only way to make AI, or this is the primary way that everybody's going to work. So my reason I'm bringing this up is because we can analyze a lot of different things. So of course, with the bubble, right? What happens with human nature in bubbles, right? Well, what happens is everybody gets FOMO, fear of missing out, and they start buying in. And also, you got a lot of circular reasoning, right? So, for example, like OpenAI, it's not profitable, losing a ton of money. A lot of these data center companies just losing a ton of money. But the idea is, oh, like they'll eventually be profitable because AI will just replace everyone. Well, I just list off quite a few reasons as to why AI will not replace everyone, at least not in the next, like 5 to 10 years, right? Maybe in the longer term, but it won't do it immediately. And also another thing is, change, all humans hate change, right? And it does take a while for change to occur. Yes, ChatGPT can go mainstream very quickly, but I'm saying to actually embed itself in the business layer is going to require much longer time because you need the trust of business people who know that this is not going to destroy their business or do anything stupid. And unfortunately right now, I would say, you look at OpenClaw and like how that's kind of been running rampant and causing quite a bit of issues, right? I think it's a very not certain thing. Like there's a very real possibility that AI can do more harm than good. And as such, business people will be very, not very supportive of it, or they'll try to be supportive of it, but they might hold back on implementing fully. And this is a trend you notice a lot in a lot of different industries. Now, of course, for coding, right? Yeah, it's probably really good and stuff, and that's useful, but that is going to be concentrated on a certain part of the market, right? And that's not going to be everyone. And in order to be a successful business, you do need to capture probably more of the market. And like we see, so, okay, I'm bringing this up because, a lot of people say, well, OpenAI will be profitable because it'll start integrating with businesses and, it'll just get a lot of market share. Well, then it's like, how does it become profitable if the businesses are maybe potentially having some issues with this and not necessarily seeing the desired productivity gains, right? And coupled with the fact it's burning so much money on these models. And another other big thing I think people aren't considering is the fact that, like, the average everyday person, right? Like if ChatGPT were not to, or just any AI, I keep saying that because I think that's the thing most people are familiar with, but there's like so many other AI companies out there that are very good as well. If it just stopped development totally and right now, to the average user who pays their monthly subscription, it's still extremely useful. It's very convenient, very helpful. It's just, I don't think these companies are actually going to be able to get a good bang for their buck, right? When they have people doing a subscription model. I think subscription models have blown up, but I think in this case, they don't really work because like, this is a problem with mainly in the coding sector. You have people who are on subscription models and they just blow out the token usage and they actually cost the companies a ton of money. So like this is not a way to make money. And, until there is some profitability, and like the other thing is too, it's not like a lot of these companies are like, oh, we're starting from zero. We're not making money. We're not losing a lot of money. No, they're severely in debt and like a lot of like borrowed leveraged money and stuff like that. So they're actually very behind in a sense. And so the more years pass, the more behind they get because they just owe more and more money. And then you have these weird circular kind of deals where like Nvidia and, OpenAI are like paying each other in future commitments. But then you can see how like different companies, right? Like OpenAI backs out of certain commitments and that can have like ripple effects. So I think the fundamental issue is that like when you're in a bubble, right? You can tell it's a bubble because everybody starts talking about very specific things. And as such, human nature like tends to throw reasoning out the window. And that's when you can tell, okay, we're really in a bubble. Then now if you analyze the current situation, right? Like I think if you want to predict, let's say, will the market go up or down, right? Well, if you want to predict it going down, it's not actually saying like it has to go down now. It's like, are there more factors that make it more likely for the market to go down, or are there more factors that make it more likely for the market to go up as a whole? And if we look at the current conflict in the war with the effects on the oil prices and just the kind of geopolitical uncertainty, and then you add that with the issues with private credit and how there's been excessive kind of leverage and problems there, and then you add in the fact that this could be potentially a bubble, right? And then you maybe even add in like there's a lot of like speculated like crypto stuff too, which goes along, I think, in a sense with this AI bubble. Right? So you add those things together and you just kind of consider them. And, you ask yourself, if you were to bet like, your life, let's say, on one of the outcomes of it being more likely to go down or it being more likely to go up, which one would you do? And, I think hopefully a lot of you would be clear that it's more likely that it goes down. Does it mean it goes down tomorrow? No. It's just in general, it means that there are more things that could make people concerned and worried and lead to actual issues, which by issues, I mean companies being unprofitable, companies, not actually doing what they said they were going to do, not actually making the money they said they were going to make, investors realizing that they have, issues in other sections. For example, the economy starts going south, so they start needing to sell maybe some stocks to cover other things, right? So you see all these things happening like that. And then you ask yourself, and then that's, I think, where you should kind of base your thesis off of. It shouldn't be like, oh, I heard this stock in the news, right? And then I'm going to, just like buy it just because everybody else is buying it, because that's a very circular loop reasoning, right? And you don't want that, because that's exactly how you get caught up in this bubble, right? And then you just depend on you selling in time, which nobody sells in time, right? There's no such thing as like timing the market, really, because like people who sold at the top, they didn't know it was the top. They just decided to make the rational decision to sell. And then it just so happened that the market went down after that, right? So I think that it's very important for anybody who's investing, right, to have a core set of fundamental truths that they're coming back to, and that's their baseline. And that's something that is not necessarily controversial. It's not like requiring like, okay, one of my core fundamental truths is OpenAI must go IPO at like 1 trillion market cap. No. That's a very controversial, highly risk kind of thing to have as a fundamental truth. You want a very basic, like very clear, stable explanation, or just like not even explanation, just an observation of what can happen, right? And you're just saying, is there a non-zero chance, or is there like a relatively chance like above 50% that, let's say, we could be in a bubble? Okay, if that's yes, then if we are in a bubble, then what do we expect of bubbles by learning from history and like past things, right? Well, some of the companies are going to go bankrupt. Okay, well, what companies are most likely to go bankrupt? I'm not saying which ones are, I'm just saying most likely, right? Well, then you look at, okay, their earnings per share, you look at their like financial statements, you look at how much debt they have, you look at who are supposed to be paying them. Are they paying them with actual cash, or is it like just, loans and obligations for future payments, right? And then you also look at the investing landscape, right? The competitive landscape for AI, right? So for example, one great example is NVIDIA. From the very beginning, everybody's like, oh, NVIDIA is going to be the sole chip maker, right? And that stood true for a very long time. But then things changed. Other companies started developing chips. And are they exactly the same chips? Are they better chips? No, right? Like that's not like the most important thing. But I think what the market had priced in was the fact that NVIDIA will be the poster child. They will make the most chips, and everybody needs to buy chips just from them. And that is like where that stock price is at. Then if anything changes, then it has to adjust, because now, let's say, for example, NVIDIA, let's say they don't sell as many chips, or other companies start making their own chips. That switches the whole competitive business landscape to the fact where the stock has to go down. Like, in the sense, like, people may not realize it, but eventually it has to go down because there is a change in the fundamental business of a like kind of model. And then also you see now NVIDIA is trying to branch out a lot, which is like, that's fine, right? It's doing like other stuff. It's acquiring like a startup, and like, it's trying to do like more AI related things on its own and enter into open source, it's fine. But I'm just saying, like, you need to think about what people's first initial reaction was, because a lot of people have that initial reaction about a stock, about a company, and then they don't ever consider it again, right? They don't ever come back to it. They don't ever see, oh, has anything actually changed? And we know that humans hate change, right? So like, even though this is change and people are betting on there being an AI, like, kind of growth and like boom, and everybody's going to do well, like, a lot of people don't revise their investing thesis when things change over time, and like people start to realize, wait a second, there are certain factors of what I previously assumed that are actually changing, and therefore that's going to lead me to need to change my investment thesis. Yeah. So now I'm going to share, I guess, a couple of the companies that I'm like kind of betting against in a sense, and like some of the reasons why I'm betting against them. So one of the biggest companies I'm betting against is MicroStrategy. So they're just pretty much, all they do is they just buy Bitcoin, and then they just hold it. And then they have this like treasury, like some sort of like ETF thing where they pay back money or it's a bond, something like that. They pay back money to investors. But pretty much you can just view it as like a leveraged Bitcoin company. Okay. And so the problem with Bitcoin is we've seen it like, people are like, oh, it's going to be used for payments. I remember this, like, this was early on. Everybody's like, it's going to be everywhere. There's institutional adoption. And the term institutional adoption just means that like a bunch of banks, or I don't know if it was banks, but a bunch of like firms were buying it, right? Big names, right? And then so all the retail investors were like, oh, that's a good sign because that means they believe in it. Well, I saw something recently that I think definitely made me think and like, kind of reconsider that as like institutional support, because just because a firm buys a bunch of Bitcoin, they don't show, how much of, let's say, a option contract or derivative they have against the underlying, right? So for example, if they buy a bunch of Bitcoin, they could also have a bunch of other like contracts where they're betting against Bitcoin. And the idea of this is that you would actually have zero exposure to Bitcoin. So for example, if you buy a bunch of like contracts that say Bitcoin's gonna go up and you buy a bunch of contracts that are gonna say it's gonna go down, well, like if either of those happen, you don't have a change because you're like, one side would gain money, the other side would lose money. And so effectively you have zero. But the thing is, I don't think the public can necessarily see into that very much. And so we may just see them buy a bunch and then we may not see what's going on behind the scenes. Additionally, you look at like El Salvador, right? They tried to implement a lot of Bitcoin for payments and it's just very unstable, right? And so like there's a stronger trend actually towards stablecoin adoption, which doesn't rely on Bitcoin, doesn't have anything to do with it, except it's also just like crypto, but it's backed and it's very stable because like this was a fundamental question I had in the very beginning. It was like, okay, if I pay with Bitcoin, right? It's like paying with a stock. Well, if the stock suddenly changes that day a bunch, like how am I going to pay? Because then like I just lost a bunch of money through the like couple seconds that the transaction happened or, like all that kind of stuff, right? And there's a lot of fees and things like that. So that was like a fundamental question I had, right? And so it's like when you have these fundamental questions, it's very important to recognize them and try to answer them yourself and not be influenced by what other people say. And I think just a general point of view is like, you need to really limit your inputs, as in like limit what source of information you actually listen to. Because if you listen to everybody, you're just listening to like the majority of people, which is, majority of people invest in AI, lose a bunch of money, just like how majority of people invest in dot-com bubble, lost a bunch of money, just like how a bunch of people, invested before the 1930 crash, like Great Depression, all this stuff, right? So like you need to really just consider like who you're listening to and what are some good inputs, right? So, I mean, I personally have some like two recommendations, right? One of them is Michael Burry. He has a Twitter account. You can read some of his stuff. Another one is Clear Value Tax on YouTube. He's like really good about just like breaking down stuff that's going on in the economy. So it's like you want to have a couple, really high like integrity and sense like sources of information that you can kind of trust. And of course, you should never really just fully trust. So just because somebody says, oh, I'm going to, short this company, you do not blindly short them because everybody's style is different. And if you copy them, you're not copying their entire style. So there can be different caveats to that. That person may be willing to wait 15 years for that to play out. Another person may be willing to only wait 1 year for that to play out, right? So there's a very big difference. And this is why you always have to do due diligence, even though we love the idea of just copying somebody else and then you hopefully could make a bunch of money off of that, right? But this is not how it works because it's not good for you to put money out there without actually doing research and not having your personal conviction around it. I think that's the most important thing. You need to be skeptical of a lot of people, right? Of who you get your information from, because it's been proven time and time again, most people are just wrong, right? So if you listen to most people, you're just going to be wrong and you're just going to lose a bunch of money, right? Going back to what I was saying though, so MicroStrategy, right? They just buy a bunch of Bitcoin. So in the early days of the crypto boom, right, that was a great thing because everybody's like, oh, it's just going to keep going up and up and up because Bitcoin keeps going up. But I would say from a first principles approach, right, whenever you have a situation where something only goes up because something else goes up, you have to ask yourself, what if the other thing goes down? What happens, right? And the idea is, oh, they have so much cash, they'll be fine, all of this, right? Well, it's not going to be that easy, right? It's not gonna be that simple because there's gonna be a lot of situations where there could be, like a liquidation event, you have to sell a bunch and it quickly unravels. So a lot of times that like upward spiral can also become a downward spiral. And you have to ask yourself over time, especially with Bitcoin not being able to actually like, let's say, be used for payment. It has no functional purpose, right? So it's like, people value it because it's scarce, right? But why do people value it? Because it's scarce. There's a lot of things in this world that are also scarce, right? There's like, I can't list off some things. I don't have anything on top of my head, but it's like, just because it's rare doesn't mean it's actually wanted, right? Like there's a lot of diseases out there that are rare and like nobody wants those, right? Or there's a lot of like other like problems people have that are rare, right? So it's like, you need to evaluate it not just as, oh, it's rare, so therefore people want it, and because people want it, it's valuable, right? You have to think about, there has to be some sort of functional purpose. Even gold, right? Gold does have a functional purpose as like a bottom line store of value. And it is something that can't necessarily be like wiped out, right? Because even for hundreds and hundreds of years, people have deemed gold as valuable, right? But Bitcoin is trying to do that. But the problem is like, well, what if people don't think it's valuable anymore? What if there's like an attack? What if something happens, right? Then the thing unravels. And the same thing would happen with gold. But the problem is gold has just so much, hundreds of years of backing that it's very unlikely that will change, versus Bitcoin is not hundreds of years of backing, right? And maybe eventually it will be, but I just don't think this is the time now. So that's kind of the bottom line truths, right, that I've been using that have kind of been informing me of how I should approach a situation with MicroStrategy, right? And then I'll list off the rest of the companies here. I don't want to make this too long. One of them is like CoreWeave. So pretty much like AI data centers, stuff like that. It's not the fact that they're doing that. It's the fact that they have so much leverage and they're extremely unprofitable, and they have a very targeted and reduced consumer base, right? So in the sense of customers. So they're only getting paid from a couple people. So it's like imagine you're getting paid by 5 people at like 5 companies, right? One of those goes away, that's like 20% of all your money, right? And then another one goes away, and that's like you're just very quickly losing money. You're not diversified very well. And if you take out a lot of loans, you have a lot of obligations for debt, all this stuff causes a lot of problems. So that's why I'm betting against CoreWeave. NVIDIA, I already explained earlier, I think that the narrative around chips has changed a lot. And you should also look at their kind of financials, because it's kind of complicated, but there can be a lot of manipulation kind of going on, right? Oracle, that's another one I'm betting against. Nebius as well, right? Also Iren, so IREN. Iren is like used to be a Bitcoin mining company, and now they're trying to become an AI infrastructure company. And like when you see, like for example, GameStop, right? It's a red flag just because of the fact that it's no longer a business and it's just becoming a speculation company, right? Same thing with like MicroStrategy, right? It's like it's no longer like profitable because now it's just becoming a speculation like thing. And so like all this stuff is just like when you have all these people leaving another industry to try to join like an AI infrastructure industry, it's because they think that industry is hot. And in the time of a bubble, that does not mean they have some sort of advantage, right? That just means they're just flocking like sheep to this one thing that they think is like going to make more money. And that in itself could be a red flag, because if you don't have experience to actually run and be successful in that area, right? What makes you think that as a later player on the scene, you can actually do well there? So that's my kind of overall approach. I think it's really important to look at charts over time, study history, understand financial statements, understand also the pressures that these CEOs are under, because a lot of these CEOs, right, are under enormous pressure from investors, from shareholders, from all this stuff, and that they want to maintain this idea that they are doing well, right? Nobody wants to, like purposely, no CEO is going to be like, I have to be completely, fully, 100% truthful. And I know if I'm truthful, all my shareholders and investors will sell a stock. My company will become less, it won't be number one, it'll become number 2. No, they're going to be blowing it up. They're going to be like, we're going to be the next generation company. They're going to say all that because that's going to allow more people to pour more money into their company. And that way their company can continue to run with more money and do more things, right? Like as much as we want all our CEOs to be like little angels, the truth is they're not, and they're just human beings. And we know that human beings oftentimes will lie and they will do things to make themselves look better as well as enrich themselves. And this is not a statement against rich people. This is just a statement against everybody, right? Everybody will do this. If you're rich or poor, you're going to do this. And so you have to account for the fact that being a CEO is just like being a percent of a human, right? So like if you have a human characteristic flaw that all humans have, then that will just be projected and magnified in any company, right? So that's why you have to kind of take what they're saying with a grain of salt and really do research to see what are the different ways that they might be like manipulating things and hiding things behind the scenes. But if you have any other questions, put them down in the comments below. I'm definitely interested to see how this all plays out. I think that right now, my overall strategy is just that like things are going to go down because there are too many reasons for things to go down. And there are more reasons for things to go down than there are reasons for the stock market to go up. And thank you very much.